And thanks for staying with us on the marketplace. My name is Darryl Kwao. We start with this one. The price of crude oil continues to fall as the commodity, which peaked at more than $130 a barrel in March 2022, has given up all the gains triggered by Russia's war in Ukraine, falling to around $94 a barrel. Now, if this continues, prices of petroleum products are on the local market will see the biggest reduction in the next pricing window on August 15. Joining us is researcher with the Institute for Energy Security, Fritz Moses. Good afternoon to you. Fritz, does this decline have anything to do with OPEC's announcement of a quote hike? What are the reasons for the decline we are witnessing now?
All right, good afternoon, Darryl, and thanks for having me. Not necessarily. The OPEC increase in their production output by some 100,000 barrels a day. It's not really enough. I mean, it's not really taking market analysts and traders as we'd have anticipated. Of course, that announcement is about 0.1% of the global petroleum or oil demand per day. So it's not really a triggering effect. What we are seeing rather, what's causing the demand, the price reductions has been the global demand anticipation or fall in demand that we are anticipating. Of course, we see how economies in the US and UK and China are anticipating a dwindling of demand. We've seen how the PMI data from China points to a reduction in manufacturing activities over the 700 manufacturing companies in China that were analyzed. About they all point to a downward decline in manufacturing activity in there. We see also for UK, just yesterday, the Bank of England announced a 50 hike in their rates, 50 basis point hike, the largest since 1995. We are pushing the rates to about 1.75%. And of course, they're also anticipating a recession that may last for some 15 months. That's together with the increase in inflation rate in the US, the anticipation of inflation in the US and Europe and the global economy largely. We've seen how the IMF much recently downgraded the local and the global economic growth to about 3.2% from 3.6 just April this year. This all pointing to how the demand will be affected. So generally, what we are seeing is an anticipation. Of course, is a market reacting to anticipated decline in demand for products, and of course also with supply being existent, supply keeps on increasing. We don't foresee any supply glut in the immediate future. Of course, we're anticipating that the 100,000 barrel excess capacity that the anticipated 100,000 barrels that would have to come on would come from Saudi Arabia and UAE and perhaps also Kuwait. Would also increase the supply that would be available on the market. But demand is what analysts are fearing and traders are fearing that would continue to dampen or reduce prices on the international market. For locally, we don't see that translating to local prices for petrol and diesel and the other products. This is because we don't see, or the cedi rate against the US dollar is not performing its role as we'd expect that. Whereas prices are falling in the international market, we will see a cedi strengthen against the US dollar. Unfortunately, from the end of the last pricing window till date, we've seen the cedi fall by some 3% against the US dollar, depreciated by some 3% against the US dollar, selling then around 80 to 35 pesos. It's currently around 80 to 70 pesos. And so, if this trajectory of the cedi depreciating continue to progress as we are seeing, and international markets prices, of course, continue to also fall, then we may not see that reflect largely at the various points.
Disappointing because we're quite upbeat that with the declines that we are seeing, prices of products will go down significantly locally. But like you point out, there are factors at play. Factors to do with the performance of our local currency against major trading currencies. As you indicate, the cedi has been depreciating over time. Well, let's talk about this downward trend, a little bit more about this downward trend that we are seeing and for how long this is going to last. What factors are at play?
Well, of course, like I stated earlier, I mean, what we are seeing is the global economic recession that many U.S. and economists prefer we don't see, that we are anticipating. We see how the economies around the world, in U.S., China, in UK, are all facing a downturn in economic activities with inflation rising, and how that would affect demand. We see in US especially, there's been a decline in consumption of gasoline, that's petrol. The API, that's American Petroleum Institute, reported an excess of 4 million barrels of gasoline crude inventory recorded in just the last ended month of July. And so it points to the fears of analysts and traders that demand certainly is falling. We are seeing, however, in Europe, although we are seeing a fall in demand for oil, and gas especially, the focus is now on oils. And so whereas gas demand is falling in Europe, we are seeing a shift to oil demand. Countries like Germany are increasing their reliance on oil-powered plants or units to meet up their energy demands. Also, of course, you see how in Europe currently they've been able to reduce their reliance on Russia's gas by some 50% and increase their LNG imports by some 100%, I should say, from 70% of their total imports to about 39% there. Of course, imports coming in from Algeria, Azerbaijan, is what is accounting for these increments. So the current economic situation, although not very favorable for the oil market, it's for oil traders and big oil corporations, IOCs. For consumers, it's a good thing because we continue to see, and of course we anticipate that to the end of this year, you'll be seeing a dwindling oil prices. We may see prices come lower than the $90 per barrel, hopefully even before the first half of August ends. If that should be the case, then
okay,
that we will continue to see. We may see prices at the various points marginally reduce, but depending on the situation of the local currency against the US dollar.
When you say marginally, are you able to hazard a guess as to how much you're going to see the prices go down?
Well, for now, we will still have to wait for figures that will come in by the end of next week. We anticipate that certainly we may see some marginal reduction, but it all comes down to how the city would react against the US dollar. Because the international market is doing its best for us consumers by experiencing some reductions in the prices from around $103 per barrel of oil when we started the end of the last window, currently around $94 per barrel. And the anticipation is that we would see further reductions. Just a few minutes ago, the US released its jobs report. That
was pretty impressive.
Exactly. And so that means that there is the anticipation for increased economic activity and the anticipation for further rate hikes in the US it's real, and it's something that would happen. If that should be the case, price on the international market will certainly fall.
We'll leave it here. Thanks so much, Fitz Moses, researcher with the Institute for Energy Security, for speaking with us on the crude oil prices, which are going down globally. We've been examining what the impact is going to be on the local market.